Nvidia just delivered another extraordinary quarter. Revenue reached $96.2 billion, up 106% year-over-year, while data center revenue jumped 117% to $89 billion. EPS also beat expectations. On the surface, this looks almost impossible to criticize. Yet the initial market reaction was surprisingly cautious. Why? Because expectations for Nvidia have become extraordinarily high. Investors were no longer asking whether demand was strong. They were asking whether Nvidia could maintain its economics as the AI build-out becomes larger and more expensive. That distinction is the real story behind this earnings report. The headline numbers clearly exceeded expectations. Revenue came in at $96.22 billion versus roughly $92.27 billion expected, while adjusted EPS was $2.22 versus approximately $2.09. Revenue also increased 18% sequentially. This is important because Nvidia is now operating at a scale where simply maintaining double-digit sequential growth requires billions of dollars of additional demand. Yet the company is still doing it. Net income reached $59.7 billion, up 126% year-over-year. So the fundamental question is not whether Nvidia is executing. It clearly is. The question is how long this extraordinary growth can remain economically attractive. The most important number remains data center. Revenue reached $89 billion, up 117% from a year ago and 18% sequentially. That tells us something important about AI spending. The infrastructure cycle has not yet peaked. Nvidia is selling into a market where hyperscalers, frontier AI labs and emerging AI companies continue to expand computing capacity. More importantly, growth is not coming from a single customer or a single model. Nvidia says the ecosystem is broadening across frontier labs, startups, open models and physical AI. That makes the current demand cycle structurally stronger than a one-product boom. The next quarter outlook may be more important than the quarter just reported. Nvidia expects approximately $108 billion of revenue, plus or minus 2%. That is another massive sequential increase and is above Wall Street expectations. Even more significant, Nvidia's guidance assumes no data center compute revenue from China. In other words, the company is forecasting another acceleration without relying on a market that remains constrained by U.S. export controls. This suggests the growth engine has become sufficiently large and diversified to absorb geopolitical limitations. For investors, that is arguably more important than another earnings beat. Here is where the narrative becomes more complicated. Nvidia delivered a 75% gross margin in Q2, but guided to approximately 74% in Q3. Management expects margins to bottom around 71% to 72% in Q4 before stabilizing around 72% to 73% in fiscal 2028. That is a meaningful change for a company whose extraordinary profitability has been one of the strongest arguments supporting its valuation. The issue is not collapsing demand. It is that the cost of satisfying that demand is rising. Investors therefore receive two messages: growth remains exceptional, but the economics of that growth may temporarily become less attractive. The pressure is coming largely from memory and component costs. This is an interesting inversion of the usual semiconductor problem. Nvidia is not struggling because customers suddenly want fewer GPUs. It is struggling because the entire AI infrastructure ecosystem is consuming enormous quantities of critical components. Management expects the pressure to persist into the second half of the year, with pricing actions planned to help offset the higher costs. That means the margin decline may be less about deteriorating competitive power and more about an industry-wide supply constraint. The key question is whether Nvidia can eventually pass those costs through without slowing customer demand. This may be the most important qualitative signal from management. Nvidia remains supply constrained. In other words, the limiting factor is not customer appetite but how quickly Nvidia and its supply chain can deliver complete AI systems. That changes the interpretation of the margin decline. If demand were weakening, lower margins would be much more concerning. But if demand continues to exceed supply, Nvidia has greater pricing power and visibility into future orders. Reuters reported that management expects approximately 70% revenue growth for fiscal 2028 despite those supply constraints. That suggests Nvidia believes the AI infrastructure cycle still has substantial runway. The next major catalyst is Vera Rubin. Nvidia says Rubin is already in full production, with systems ramping at several major cloud and infrastructure partners. This matters because Nvidia is not simply extending Blackwell's life. It is accelerating the architecture cycle while AI workloads themselves become more demanding. Rubin is designed for the next phase of reasoning and agentic AI, where models perform increasingly complex multi-step tasks. If those workloads expand as management expects, compute intensity can rise even faster than user growth. That creates a powerful mechanism for Nvidia. Better AI creates more demand for compute, which creates demand for newer Nvidia platforms. Another important change is the composition of demand. Nvidia's CEO emphasized that the build-out is no longer being driven by one major AI laboratory. Multiple frontier labs, startups, open model developers, and physical AI projects are now scaling simultaneously. This matters because diversification reduces dependence on any single customer's capital expenditure cycle. It also expands the addressable market beyond training. Agentic inference, robotics, and physical AI can create recurring demand as AI systems perform more tasks in the real economy. The bullish argument is therefore shifting from "more models need GPUs" to "more economic activity is becoming compute-intensive." But there is one question Nvidia cannot answer with hardware shipments alone: are customers generating enough economic returns from AI to justify this spending? That concern explains why investors initially focused on margins rather than revenue. The AI infrastructure cycle ultimately depends on customers continuing to invest because AI creates measurable productivity, revenue, or strategic advantage. If those returns disappoint, capital expenditure could eventually slow. For now, Nvidia's management argues the opposite. AI is moving from experimentation into productive workloads, and the economic value of compute is increasing. The next phase of the story therefore depends increasingly on proof of AI ROI. China remains a structural uncertainty. Nvidia's current Q3 outlook assumes zero data center compute revenue from China, highlighting how export controls have changed the company's addressable market. Nvidia has also faced growing domestic competition in China, while recent U.S. policy changes have created uncertainty around which products can be sold there. The important point is that China is now more of an upside variable than the foundation of the forecast. Nvidia is demonstrating that it can generate enormous growth without assuming Chinese data center revenue. But a meaningful reopening of that market could still provide additional upside if policy conditions change. So what actually changed after this earnings report? Not the fact that Nvidia is growing. Everyone already knew that. The new information is that management sees another major growth cycle ahead even while the company remains supply constrained. Reuters reported that management expects roughly 70% revenue growth for fiscal 2028, significantly above the growth rate investors had been expecting. At the same time, Nvidia openly acknowledges margin pressure. This creates a more nuanced investment narrative. The demand thesis is strengthening, while the profitability thesis is temporarily becoming more complicated. The market must now decide which of those two signals matters more. My analyst takeaway is straightforward. Nvidia did not merely beat earnings, it demonstrated that AI infrastructure demand is still accelerating at extraordinary scale. The strongest signal is the combination of $108 billion Q3 guidance, 117% data center growth, supply constraints, and a roughly 70% FY 2028 growth outlook. The main risk has shifted. It is no longer simply whether AI demand exists. It is whether Nvidia can convert that demand into sustainable margins while navigating memory costs, China restrictions, capital intensity, and questions about AI returns. For now, the evidence still points to an expanding AI cycle, but investors should watch margins and customer economics as closely as revenue. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.